Welcome back. Allcargo Group, which comprises of Allcargo Logistics, Allcargo Gati and Allcargo Terminals, reported their Q4 numbers. Now, while Allcargo Logistics saw a revenue surge of about 24%, for the other two businesses, Gati and Terminals, the revenue growth was in low single digits, but Allcargo Gati did see an EBITDA surge of nearly 34%, while Allcargo Terminals EBITDA went up by nearly 10%. Ravi Jakhar, who is the Director of Strategy and the Group CFO at the Allcargo Group, is now with us. Ravi, thank you very much for joining in. So let's start first with the Allcargo Logistics business. While the top-line growth was strong for FY25 with a growth of about 24%, the EBITDA margins contracted 3.2% versus 3.6%. What explains that and what is the guidance, the number for FY26?
Hi, sorry, it seems like I got disconnected in between, but making this of your question around the trend of the last quarter and the trend going forward.
So we wanted to specifically focus on Allcargo Logistics. If you could explain what led to the dip in margins and the guidance for FY26 on margins for the logistics business.
Yeah. So on the Allcargo Logistics, which is primarily driven by the international supply chain business, I would say one needs to look at the absolute numbers because a large part of revenue is a pass-through cost. And if you see on a quarter basis, on a year-on-year basis, we saw both revenue and EBITDA on consolidated basis expand by about 17 and 18%. For the full year, we saw revenue go up by 24%, reflecting more on the average freight rates. And the EBITDA went up by about 12%. And the gross profit is also about in the same range. What we observe is that there has been quite a lot of volatility with the tariff and trade deal announcements over the last few weeks. It seems to be settling down now. There seems to be more of a narrative of reconciliation, and that should bring in stability in the long term. That's our expectation. In the immediate period, since there was a few weeks of sailings missed on China to US Trans-Pacific trade, we are now seeing a significant revival. So there's almost like a 65% decline in China-US trade, which is now rebounded sharply as well in the week gone by. So we believe that there could be some near-term volatility for this quarter, but beyond that, things should stabilize and we should see, trade recovery happening. And that should mean that we should see volume growth. Freight rates may remain slightly higher because of these disruptions in the coming months and then the ensuing holiday season to start with.
Ravi, good morning. Thank you for joining in. So with all of this, tariff uncertainties and with some recovery and some not, what are the kind of volume growth targets that you're penciling in for the logistics business in FY26 and add the margins bit as well, because compared to FY24, your margins were slightly narrower in FY25. So do you expect that to improve as well?
Yeah, so I would say that, if you look at the growth in the FCL business, the industry addressable market for us grew in the range of about 5%, while we grew by about 7%. The addressable LCL consolidation market, in our view, shrunk last year, and which is why we have seen some of the competition, reporting. It's not in listed space, but in the private space, we believe decline. We have seen about 1% growth. What we expect for the year coming by is we believe that the LCL growth rate and FCL growth rate both should be normal, which means that, FCL growth rate, adjusting for the tariff impact, should be about 3 to 4%. LCL could be about 4 to 5%. And in both these segments, we would outperform the market. FCL possibly in the similar proportion as this year and LCL also. Because if you see our growth across small forwarders has been very good in the last year as well, almost close to double-digit numbers. So therefore, I would say that in both LCL and FCL, possibly we can expect high single-digit growth coming in the year. As far as the profitability is concerned, we have held on to the yields. Yields for us is profit we make on every unit of cargo carried. So from that perspective, the gross profit should do well. We are also looking at the year 2025 as a bit of a year of consolidation. We're looking at a lot of initiatives in terms of restructuring, bringing in technology, optimizing operations costs. So there'll be a little bit of flux on the SG&A costs, but directionally, if I look at FY26 towards the exit numbers, we should see similar or lower SG&A costs and much enhanced gross profit. So from an exit FY26 perspective, we should be seeing much stronger profit numbers, what my expectation would be.
Okay, so exit margin should be higher. So EBITDA exit could be 3.6%?
Like I said, percentage terms may be misleading, but on absolute terms, we should be seeing.
So what are the yields then? Fair enough. What are the yields? You said you managed to hold on to yields.
Yeah, so yield is, the gross profit that we make on every unit of cargo that we carry. That's how we typically measure our top line performance, not by revenue. And like I
Is
said,
there a number on
no,
yields?
there's no specific number per se that we share. But if you look at the gross profit that we report, and if you look at the volumes that we report a combined number. Directionally, since both segments would see a sustenance or improvement, therefore the gross profits should grow more or less in line with the volume growth that I've indicated earlier in my comments.
What's the target revenue mix for all cargo logistics between air volume, contract logistics, and express logistics?
So we have the international business, in which air is about 5%, and LCL is majority, more than 60-65%, and the rest is full container load. On the domestic side, we have express and contract logistics. We believe that contract logistics, we should be in the range of about 25-26% on the domestic side, while express should comprise almost 75% of our revenues for FY26.
What about Gati, Ravi? Your FY25 EBITDA grew 34%. Margins were also up 100 bips. So growth is visible for Gati. Does that momentum sustain in the new financial year as well? What are the kind of plans that you have here?
Yeah, so if you see on the Gati side, we have seen a flattish revenue, but a strong growth in EBITDA. And that has been, the mixing up of the revenue. We are kind of letting go some business which is of low quality, and which is why in the preferred business we have grown, even though the overall revenue shows flat. So we believe that now with operations being very stable over the last more than 12 months now, we should be in a position to ride on the market growth and perhaps see a good, strong sales performance in FY26 as well. SG&A is a sharp focus. You would have seen the numbers. We continue to contain them. We do not see them growing much. So therefore, operating leverage should continue to play out. And what trends you have seen in this year should continue in FY26 as well on the express business side. On the contract logistics business, you would have seen a strong revenue growth. However, I would say the EBITDA impact was not in line with that. And that was primarily driven by a high degree of white space than what we would be usually comfortable with. Now, we have a few specific leases coming to an end in this financial year. So we believe that once that is done, we should be able to normalize the white space as well. So a normalized white space would mean that we do not have a wasted operational cost, and that should also help translate the entire revenue growth. It's almost been 48% growth that we have seen in contract logistics business. That should also translate into a bottom line impact in the coming year.
One final question, Ravi. Then what is your market share currently for the Allcargo terminals business, and what are you targeting for this year? And if you could also tell us what are the kind of volume improvements that you're expecting for Gati, considering the fact that there are eight new hubs that are coming up in the next 2 to 3 quarters?
Yeah, so we believe that, in Gati, we are hoping for a double-digit growth on the top line, which should be in line with the volumes. We believe that yield should also improve. Allcargo Terminals is a separate listed company, just to clarify, though it's part of the same group. It does not come under the Allcargo Logistics entity. On Allcargo Terminals, we are the largest CFS operator, and I would say we had a good problem in the past. Our yards were fully utilized, and therefore we were looking for additional capacity. We expect to find some strategic opportunities to expand capacity and thereby grow revenue. And we're also working on our inland container depot, the ICD in NCR, which should also pick momentum in terms of the construction and development in the coming FY26. So overall, Allcargo Terminals has been generating strong cash flows, and we believe that business has opportunities to continue to grow in CFS and also now in the ICD and NCR.
All right, Ravi, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The Allcargo Group there. Various growth plans across business entities. Take a short break, but just before we do that, we are excited to unveil our brand new global business news channel, the CNBC-TV18 and all new CNBC-TV18 Prime, a channel that will provide live and in-depth coverage of global markets and economic developments through an India-first lens. In an inaugural episode of the Global Reset, we will be speaking with Chairman and CIO of GQG Partners, Rajiv Jain, today at noon. So do tune in to CNBC TV18 Prime.